I picked Tabani to be the winner.
Yeah.
So this would have been in and around the time Resolute had all their drums. I think a little bit after. So.
Oh, so you'd be killing it. Maybe up 3 times then.
And on the short side, Boss.
Wow. Well done. That's a good one.
Yeah, and Min's $40.
Oh,
Yes.
well done, JD.
I think you tick the
man.
so.
Yeah.
Peter Prendiville, Chris Wiener, welcome to Money of Mine.
Thanks for having us, guys. Yeah.
Thank you so much
privilege.
for joining us. Norfolk Capital. Norfolk Capital, that's right, isn't it? It's
Yeah.
not Norfolk Funds Management.
Yeah, Norfolk Capital Management.
Norfolk Capital Management. You guys, you guys manage one of the newest funds on the block, and I mean newest, not in a derogatory way, because your returns certainly to date have probably beaten every fund manager in the space. But we're delighted that you're joining us and going to share your insights, your journey into funds management, investing in the sector that we all love, which is mining stocks. And we're delighted that you can join us.
Yeah, thanks for having us. I think you're right in saying that we are a new fund, in that I think our strategy was only, which is purely energy and resources focused, was only established properly about a year and a half ago. The fund in its structure, I guess in its organisation, has been operating since 2021, but the kind of value-driven, long-only energy and resources mandate that we've been running has probably only been really engaged for a couple of years now. And Chris came on board about a year and a half ago. But the returns profile has been there for a good 4 years. So we've got some track record, I guess, and now we're sort of showing our faces, getting out there.
Was it a sort of long-term goal that you guys had, or is it more of a natural evolution to get where you are today?
It was a bit of a stepping stone process for me. I was a capital markets lawyer for a long time in mining, so mostly focused on small and mid-cap opportunities, IPOs, placements, whatever have you within the corporate and capital markets world. And then I did about 5 years over in London as a M&A and joint venture lawyer on trade and shipping. So gave me some pretty good perspective on what the world looks like outside Perth. And I've sort of been investing along the way through that journey. Had some good successes, which I guess kept my interest in investing in that space. And so when I got back from the UK, I tried to upskill myself a bit, studied geology and finance, and then created the structure that is now Norfolk. So that's kind of a bit of a backdrop to how my investing career came to be.
And you run it as a two-man band now, but where did the relationship start for the two of you?
Yeah, so I mean, Pete and I we've been friends and known each other for a very long time, but I've got quite a different background to Pete. I sort of started I did a bit of time at a Big Four in auditing. I then moved into the valuations team and worked on independent experts reports for quite large mining transactions. I then moved into investment banking, corporate finance at brokers and various shops, and Pete was a client of mine there, so that's how we sort of rekindled our relationship and did a few transactions together. And a year and a half ago we I studied chartered accounting and did my corporate governance, Institute of Governance course. That's quite a complementary skill set to Pete's legal and geological background.
Bring different skill sets together, especially I didn't have the analytical or valuation components tied down, and a very experienced set of hands, and wanted to get into funds management. So it was quite a natural fit.
Yeah,
it is remarkable to me that a lawyer and an accountant have backed to pre-discovery stocks, and it's not like you had a spray and pay approach. You were pretty targeted with your positioning, but you've had two positions in exploration companies which went on to discover something very, very meaningful in very short order without actually having a geologist kind of qualification. But that's kind of remarkable. And understand, Pete, you've done a lot of groundwork on learning geology.
Yeah, I think my geology sort of studies occurred after those two discoveries. So I can't really sit back and say, I'm the greatest geologist in the world. I think we'll go into the three kind of areas or pillars, I guess, of our investing strategy in mining, and the first being exploration and discovery. You really need to understand that there is risk and luck involved in exploration, and it's not so much that it's pure luck, it's just that whether you can upskill yourself to a level which means you need less luck than the next person to find a discovery or to hone in on somewhere which might potentially give you a discovery. It's kind of the angle that we take. So when I say that, I mean, from a greenfields perspective, let's say, which were probably the two that you were referring to, understanding the team, whether they've been out into remote areas of the world or underexplored areas, what the initial geochem and geophysics looks like, I think is really important, because they're the only lead indicators that you can follow to see whether something makes sense or not, and whether the management are actually implementing a geophysics and geochem program which aligns with the targeted ore body, what they're trying to target. So, for example, in the West Arunta, I think the initial geophysics was aiming for IOCG targeting for WA1, and they ran gravity, they ran passive seismic, and they ran magnetics. And those are the three primary geophysical targeting methodologies that you would run to target that type of ore body. It just happened that that's the same mix of geophysical methods that you would run to find a carbonatite as well, little beknown to the team at the time. So if I could distill it and give any sort of feedback, it'd just be try your best to understand the ground that you're working with and whether there's actually a warranted reason to be out there plugging holes, or whether you're just, drilling wildcat holes for the sake of it.
So you mentioned the course came after that outstanding success. Did that sort of light the fire to go and do a bit more?
It did, yeah, because I did a lot of work on it at the time, pretty much because I was in and around the management quite a bit, so it was of interest to everyone around. But it really got me thinking, if you're going to do this full time, you need to really upskill yourself in those areas if you're going to create a fund or a strategy that's in part around exploration.
And that is part one of the three pillars that you mentioned. So if you give a quick overview of the other two, and then we can dive much deeper into that exploration and an early stage part.
So in addition to sort of value-backed exploration, when I say value-backed, I think the value needs to be there to invest in the first place. So I should have mentioned that before. But the other two pillars that we look at are assets, or really ore bodies, which we think going forward are going to be of strategic importance, either to another corporate or namely to a government body. And the third one's really kind of bread and butter, developer producer, value disconnected investments, get a decent return, which is the market's mismatching.
So if we have a quick sort of snapshot at how the portfolio comes together, like bottom up, top down, these types of things, like you guys are long only as well in nature. Is there a target number of companies that you like to put together for a portfolio too?
Yeah, there is. So we are long only. I think at the very start we're value focused, long only global investors, and we do have a top down, bottom up due diligence process, but there always needs to be a value proposition there and a decent one. So the top down, bottom up investing methodology makes sense. You can get down the whole path and then find out that there's no value there. But we do look at the macro side of things, thematics, commodity cycles from the top up, see which commodities we want to be based in. And usually because of the value attraction, we end up looking at commodities which are somewhat beaten up. And I think that's probably the differentiator for us as value investors as opposed to a contrarian is that there's definitely some overlap, but we will be looking at companies or assets which is just simply too cheap to look away from, as opposed to just investing in things because it's against the grain.
I want to cast your mind back kind of 12 months ago, because I understand portfolio composition right now is very different to 12 months ago. But I want to like rewind 12 months ago. What were you thinking? What were your theses, and how had you kind of positioned accordingly 12 months ago?
Yeah, so I mean, 12 months ago, or sort of maybe a bit longer than that, 15 months ago, we were staring down the barrel of potentially a second Trump presidency. We had a pretty good entree to that in 2017 to 2021. There was trade wars back then. There was, tariffs and all sorts of things. A lot of that looked to be quite inflationary, especially second time round. Reshoring of everything to the US looked to be very buoyant for commodities, and also a good backdrop for precious metals as well. If it wasn't going to be Trump, it was going to be the Democrats, and I don't think it was going to be much different. They were going to keep on spending, I think. So it was really just positioning the portfolio with a steady amount of precious metals, and then a suite of these critical mineral investments, which some have played out, some haven't.
They've been pretty important for our strategy over the last 12 months, the strategic assets, if you will. So commodities like rare earths and tungsten, silver. What else have we had?
Yeah, some lithium
names in there as well. Still,
yeah,
I know
countercyclically.
not everyone, not everyone's cup of tea at the moment. But this is kind of where we like to look at things when they're in the dumps, where we can see that there might be some decent strategic value to really good assets going forward. So they have been playing out pretty well the last year, as Chris said. So our cash position is a bit reflective of that at the moment.
It was 15 odd months ago. I don't know if it was as obvious that theme would become so pronounced. All I remember was like antimony was going crazy. Maybe that was gallium. Maybe that was like a whiff of what was to come in some respects. But to predict like that rare earths would have been as responsive as what played out, or even tungsten with Almonty, like it's a remarkable outcome. Why don't we kind of pry into some of those important positions, starting with Almonty? This is a pretty underfollowed, underloved tungsten stock on the ASX.
Yeah. I mean, it's a really interesting story, and it has been for many years now, and it's only just come to light and become known and moved really. So it was the fund invested in it in 2021. It was listed on the ASX, $15 million IPO. Market cap was around 150 million. They own the Sangdong tungsten mine in South Korea, which is the largest tungsten mine outside of China. And critically, this was probably what piqued the fund's interest at the time, is China accounts for over 80% of the world's tungsten supply. Another 10 to 15% from Chinese allied nations. Back then, so it's been quite a journey from then to now, but they had a lot going for it at the time. It had a floor price offtake contract where the floor price was 2 times their operating costs. They struck that contract in 2018. The investment was made in 2021 originally. Floor price contracts are all the rage now with MP Materials, but I wasn't aware of another company that had a floor price contract. I'm still not aware of one. They had other things going for them, like they had a financing deal from KfW, the German state-owned bank, that was backed by the Austrian government because the off-taker was Austrian. So there's a lot going for it at the time, and it just felt like at some point in time in the near future, given the investment was made in 2021, that was at the end of Trump's first term, there was probably going to be a desire to secure this mineral from outside of China, and that sort of came to the head late last year when China banned the export of tungsten, and that sort of put a bit of a rocket under the stock, and they listed on the NASDAQ and raised $90 million. And
I think your point, though, when those first ones were coming out, antimony, gallium, it did sort of validate some of our thinking at the time, did sort of follow our money a few times throughout the Almonty journey that we're still currently on. At the heart of it is the Western world's desire to move away from Chinese supply chains, and I guess the underlying defence spending promises that have been made by NATO allies. Chris can probably talk to this better than I can, but the numbers are many multiple more significant than COVID spending. Do you want to chat to that?
I mean, just, the NATO spending recently. The NATO nations agreed to increase their spending of GDP to 5% from 2% per annum, and that would equate to an incremental additional spend by 2035 of $1.3 trillion from NATO nations. I went back and had a look at, I thought, when that was announced a few months ago, I thought, is this the largest stimulus package for resources in our time? And I went back and looked at what I thought might be the last time that could have possibly been topped, which was after the GFC, and the Chinese stimulus package after that, 2008, 2009, was 500 to 600 billion, so it's 2 times that per annum. Yeah. I know there's a bit of water to come under the bridge with that. Like they've got some checkpoints, and the NATO spending, I think next year they have to come up with a plan, each nation. 2029 is another checkpoint. It only comes in 2035, but I think, and that only happened recently, but the general thought was, and hope as a resource investor, is that these Western nations are going to need to come up with a lot more Western supply of these niche and critical minerals. And if you're in a project like an Almonty, which has, a tier 1 asset in a very niche commodity, at some point in the near term, it would be worth something more than $150 million. That's sort of the thinking on that one.
And it's still playing out for us at the moment. We've invested in a North American rare earth hard rock monazite asset, which is North America's largest at the moment. It's 200 million tonnes at 2%, which is by far and wide the largest source of rare earths on the continent. Even if you apply a sliver of that, of the value of that that cash to be deployed to defence to secure that supply, it by far covers that mine plus many, many others in terms of development cost if they wanted to apply it to that.
If we look at Almonty specifically, is this how you thought you'd get paid on it?
More or less.
It was
part of our strategy, I guess, is focusing on ore bodies which are important to either companies or to governments. And the thesis took a lot longer than we were happy with to play out. 4.5 years is a decent hold before it starts to break even again. But I guess the way we look at it is we're happy to hold things for a while as long as the ore body is hugely important to the world and tier 1 quality.
Stock selection there matters, right? Because you could have invested in EQR or G6.
We had a look at all of them,
and you would have lost. You would have lost money.
Sure, and they will probably come right in the right pricing environment. But when you're looking at tungsten on, it's almost doubled in the last 3 months. When you're looking at a prior pricing environment, a lot of those marginal assets are difficult to sell to other investors, other institutional investors who are going to drive the price.
I think on the Almonty one, it was interesting thing about it. It was the valuation was backstopped by a base case earnings rate without any trade wars or tungsten now being used as a foreign policy tool. It was still undervalued by probably 100% just based on normal operating environment. But there was always that defensive strategic angle, which was the real, upside case, which has eventuated.
What are the other? So I guess one of the risks that we identified at the time was the amount of leverage that it had, that profile.
Yeah.
Which we got comfort with given the parties involved, and I guess their perceived objectives out of the investment, which proved to be true. I mean, 4.5 years later, for a debt provider not to be paid back anything is quite the wait. Almonty at the time was actually operating and producing tungsten from another mine called Panasquera, and so we knew they could run a mine. We knew they had a mine, and if tungsten did play out the way we were hoping, they may have been cash generative from that.
Yeah, and it'd be the go-to investment in the space. That was the key
Yeah, there's
thinking.
not many Western companies producing tungsten.
One stock in your portfolio that didn't take 4.5 years to play out, but was a super meaningful part of the journey. WA1.
Yeah. That was
Ding ding ding. We've probably got to
Are
do
you
on
still?
our behalf.
Okay,
but
good.
Yeah, we're still there, mate.
that's good, mate. It's a safe space to be.
Yeah. Talk us through that experience.
Yeah, well, WA1's a very unique investment. I don't think it's able to be replicated again. I was actually travelling out to the West Arunta, for different things, potash included in a previous life, helping that management team who found Looney, and had the opportunity to start the fund in the same office. So don't know if I can replicate that scenario again now that we're a 2-person mob down in Fremantle.
It was special.
But it was about, again, for exploration for us, understanding the lay of the land first, what the targets look like, how they're going to go about it, and whether they have the right skill set to be out there. And I knew the guys had been out there for a long time. They know the land. Paul Parker came on board, who was he was the head of exploration for Sandfire and IGO for quite a long time. Very safe set of hands, very, very knowledgeable. And I gathered a lot of confidence from his the way that he and Tommy Lyons were approaching the exploration out there, how they were thinking about targeting, how they were picking up massive land packages to begin with to figure out how the broader geological and stratigraphic profile looks like in the West Arunta, because it's a completely underexplored area, and how they went about figuring out what kind of deposits might be out there, which were IOCG at the time, developing a geophysics program and geochem program that aligned to that, knowing that there's 30, 40 metres cover out there, so not much is going to come to surface. How do you go out into elephant country and find these behemoths, elephants? And that's what they did. And a lot of the time, this is what happens in greenfields exploration. A company will go out and try and find a certain type of deposit, and it'll end up being another type of deposit. It's actually the same thing that happened at Mount Weld, I believe. So I think just getting comfort that if you are going to take on exploration risk, one, that valuation that you're entering at makes sense to take on that risk, and two, that the methodology that the management team are taking to it makes sense. And therefore you need to kind of dive into the actual rocks.
Valuation aside, you've actually spoken in and around management quite a bit there. How important is that in picking under any of the 3 pillars that you have an investment?
It is highly important. I think the ore body, in our view, is more important, as in a good ore body can fix bad management. but a bad ore body can undo good management, and that's kind of the way we look at things. So it's a bit hard to answer that with examples, but we do absolutely value good management, but I think it becomes more important in our other two pillars in development and production assets as opposed to exploration. But you still need to have people that know what they're doing, right?
Yeah. And if we look at the other outstanding sort of exploration success that you guys had, Q2, which is still playing out in an unloved part of the market right now, but I'd love to have you sort of walk us through that example.
Yeah, so Q2 was a really interesting one. It was almost hiding in plain sight. They were already an explorer of lithium in James Bay at the start of last year, and then they agreed to acquire the Cisco project, which is now their key project. The vendors of the project, and this was in the announcement when they acquired the project, had a market cap of around $15 million Canadian. They drilled 3 holes into the project. One of the holes, 115 metres at north of 1%. Another hole, I think about 50 or 60 at around 1. And it looked, well, the geologists at Q2 correctly opined that they'd identified a mineralised pegmatite system of, say, 200 to 20 metres cumulative. It looked as if they'd potentially drilled under the pegmatite, and then they drilled a bit to the north, and then for some reason they stopped. So this is probably an example of one that... Yeah.
It's one that we had a really good look at, and you had sort of 3 holes drilled. 2 of them hit mineralisation, as Chris says, one's about 115 metres at above 1%, decent interval. You've got 4 or 5 stacked pegmatites that they've gone through, and then they've stepped out sort of northeast, hit a bit more, gone under it south, and then stopped and said, I don't know, for whatever reason, they stopped exploring it and sold it to Q2. Our assumption was, well, it could be any number of directions around the most southern extent of the hole. If you take a view that it's dipping back to the southwest and they've gone under it, the body could continue. 115 metres is not an insignificant interval to begin with. And we sort of thought, what's the probability that, 5 or 6 of these stacked pegmatites, one of which is 45 metres, simply form a halo of about 50 metres wide? It's pretty unlikely. It's more likely that they continue somewhere else, or there might be a fault of some sort that split them off and they continue at depth. But the idea was that area needed more exploration to test it properly, and that was the premise of the investment.
You don't often get to buy something. It's effectively post-discovery, but it's packaged and valued pre-discovery.
Exactly.
If you're a student,
it was a gift, absolute gift.
Yeah.
But the vendors took scrip in Q2. Maybe they just thought better off giving it to someone else to explore, and we'll take the equity upside, which they've enjoyed.
Yeah.
And this is one, again, it's gone from one of our early discovery opportunities to now what we think will be a very important strategic asset for Canada. So
it goes from one of your pillars to the...
It has. Now that
next
it's known there, the ore body is there. If it was part of that first pillar and we didn't think it could be moving to another one, then we'd probably sell it.
There's a lot going for that outside of the size of the ore body. I mean, the exploration target they put out the other day, 215 million tonnes to 329 at 1 to 1.4%. It's going to be one of the largest hard rock spodumene deposits globally. But in addition to that, it's 10 k's from the Billy Diamond Highway that then connects further to shipping routes. there's a lot going for it just outside of the size. So
It's from surface, kind of dips pretty favourably.
That'd be a $2 or $3 billion company a couple of years ago.
that's what we kept saying.
Yeah, or maybe a couple years from now.
Love the optimistic.
Yeah,
sort
a
of
couple
tinge to
months
it.
from now.
I can't help but have noticed a plethora of kind of acquisition stocks that have been in your portfolio over the last 12 odd months too, and I can think distinctly of New World, Metals Acquisition Corp, and Adriatic come to mind. All acquired within.
Admittedly,
the last 6 months.
we owned Adriatic as a from IPO, and saw the discovery of the Repiche deposit. That's right.
It's a good
So
idea to invest in.
we sold that, after the discovery phase, after it had all been drilled out.
Gotcha.
But it's one of those assets where, because it's so, the quality's so high that it doesn't matter. You could have picked it up at the same price, 2 years later, or paid more. Those sort of real quality assets. I'm just looking at your logo, sort of withstand the heat of the Lassonde curve. Look at WA1, even QTWO at the moment, Adriatic. They all sort of humbly, move up in a very orderly manner as they go through that. But to go to your question on MAC, we wanted sort of some larger scale Australian copper exposure when UMIC was a good operator. And it presented a good M&A opportunity, I guess, from the outset, if they could deal with the, I guess, ugly corporate and capital structure issues that they presented from IPO on the ASX. Would we have liked a little bit more of a premium? Yes. But I still think, in that environment, when you're that deep in the Earth's crust trying to mine copper, it's not a bad outcome.
Where you did get a better outcome was New World,
Yeah.
when you had the luxury of two competing bidders going toe to toe.
New World was an excellent investment for us, but it's been through a few different vehicles, that Antler asset. We've been exposed to it, I guess I should say, through different vehicles. So we first came across it when we were shareholders in Trident Royalties, which was taken out by Deterra, and they held, Trident held a royalty over the Antler asset. So we got familiar with it then. Always thought it was a great asset. Again, quite strategic for US purposes eventually. High grade, needed a few more tonnes. But that's what we saw over the last 12 to 18 months, a bit more money spent on it. Started to position itself as a viable source of copper in the US. So that was one of the reasons, as they started that sort of strategy for us to re-enter it directly, and that ended up being a good call in the end. Did we think that there was going to be a bidding war on it? No, absolutely not. But are we thankful there was? Yes. Yes, we are.
So a lot's gone the way of your kind of setup over the last 12 to 18 months. Maybe some of it luck, but a lot of it skill and a good process to support it. What hasn't gone to plan?
Yeah, I mean,
how long do you have?
There's been, I'd say, a common, without pointing out individual names, I think there's a very common thread through the ones that haven't gone right. And those are probably that where there's a commodity that's trading into the cost curve, deep into the cost curve, where the time that it trades into the cost curve is longer than we have expected or hoped. And then the key part is when they've had debt involved. And that really, if you're operating into your cost curve and you're not generating much cash and you got debt, quite often
dilution.
that's it. Yeah, it brings duress to the equity holders. So, and that's where we participate. So, and quite often a lot of these have had a decent dose of management underperformance. They're the ones that haven't worked out so well. Some in the coal sector, some in the lithium sector. They're two key sectors that spring to mind.
Yeah, I mean, we heard one of your presenters talk about vanadium being this year's big, I guess, the contrarian view, positive contrarian view, which we thought, probably sounds about right. And so we've had vanadium in the portfolio. It's been a tough hold because there's different thematics, different technologies that are coming to market which have promised certain growth profiles that haven't been met. To say that they won't roll out that way in the future, not sure. Could be a great commodity to be in, might not be as well. And so they're the kind of tricky ones where you can kind of see light at the end of the tunnel, and so you're investing now where you see value. But that light might just keep getting further and further away from you.
So everyone's numbers are different, but one of the kind of like analysts that I was looking at the other day, so 15% of vanadium demand 2025 attributable to like battery storage.
Yep.
That number was like 0% like 6 years ago. So it's an increasingly significant proportion of the composition of demand for vanadium is a big growth market.
It is. I think that's probably been exacerbated by the lack of demand in the steelmaking side of things. So as that's come down, vanadium redox flow batteries have increased, and so you've kind of got a disproportionate setting, if you will, a representation of the market. If you were to have the Chinese property sector firing on all cylinders, I'm sure that percentage would be diluted. Do we think it's an area of growth? Those vanadium redox flow batteries? Yeah, absolutely. They're incredible pieces of technology which bridge a gap between, kind of gas and lithium batteries, really. Providing somewhat long-term energy solutions, and I guess could be grid-scale battery solutions. And some of them are being rolled out in China and elsewhere, but just haven't quite seen the adoption of those batteries affect the vanadium pricing yet.
With good projects that are sort of few and far between as well, right?
Yeah, that's right. And there are a couple of quality projects, but there's also a lot of bad supply, cheap supply.
If we round out the third pillar of your approach as well, I'm really curious. This is the established producers who might be trading in the cost curve or showing value for a variety of reasons. How much time do you sort of spend, and keen to have you guys run through us a couple names here?
Yeah, we do. I mean, we do a lot of work on producers as well, and a lot of it's benchmarking and being value investors, going down the curve and seeing what presents good value. One that springs to mind that we do still hold, and I still think shows compelling value at the moment, is Glencore. It's got one of the largest coal production bases of tier 1 quality globally. Produces nearly 1 million tonnes of copper. It's got a marketing division which is worth maybe as much as the whole mining business. And you see at the moment things like Anglo Tech, BHP coming for Anglo last year, MAC being sold, NWC being sold. There's just a lot of demand for copper projects and copper mines globally, and it's something that we can't find enough of. And so we do think, things like Glencore present compelling value at the moment. That's probably one of the production names that we do hold and still think is, presents good value.
Yeah, I mean, it's presented good value for a good year and a half now,
it has.
for however long we've held it.
Yeah.
They have missed guidance a couple of times, especially their copper divisions, but it is trading historically very cheap. It's got great assets. It's positioning itself well. I think there was a lot of promise around listings elsewhere, and it kind of spooked one half of the market and then never lived up to the other half. So it's got a while to come back. But they're kind of good. That's a good example of a producer where we see value now in the right copper and particularly coal environment. It can really outperform.
I could peel into Glencore all day. Fascinating company, and my view's always evolving with that one. But some of the parts you can kind of get comfortable. Can they realise the sum of the parts value amidst a pretty dynamic landscape with the majors, and their strategy has sort of been nowhere in some respects too.
It's been a bit disjointed. I feel like they're starting to get a bit of a better hold on that. Keen to see how it plays out over the next 6 months.
Yeah. Fascinating to see Glassenberg pick up more stock recently as well, albeit small, given his sort of huge interest already.
Yep.
But it just adds to the curiosity around Glencore, I find.
The lazy 50 million, wasn't it?
Something like that, yeah. Pocket change.
Yeah, that's it.
And Firefly also in this category.
Yeah, yep. Yeah, Firefly was a really interesting one. Another thing I would sort of recommend to people looking at these sort of early stage exploration or early development is just to try and, that's one of the beauties of our industry is you can go out and meet with management, speak with management. They generally have the time for you down this side of the market. And that's a privilege that you don't necessarily see elsewhere or in other industries. But that when they first picked that up, that was the first thing we did was go and meet with management, chat to them about the Ming mine, what it had done historically, why they thought that they could explore for it differently or find more tons and copper elsewhere, which they have done and very well.
Yes, that was an interesting one. They flipped a subscale production story on its head and said, no, that's probably not the way to do this. I think we drop the production. We will put the plant on care and maintenance or keep it on care and maintenance, and we'll go and explore. And that's what they've done the last 2 years.
Yeah, and they've obviously leaned into a lot of that footwall zone that sits under the existing mine. And it's become its own refreshed story, I suppose. You're taking a good management team, a decent asset, and turning it into a very good asset. That was value backed, obviously, at the time, or what we thought was value backed in Pickled Crow. So, you've got a multi-million ounce, high grade gold deposit in your back pocket, and it was only trading like it had bought Pickled Crow. So it was a bit of a no-brainer for us on a valuation front. And it actually took 2 or 3 months after the acquisition for the market to start to catch on. So people do have time. They think some of the time they have more time than they realise to have a proper look at these acquisitions. Discovery is a little different because they're quite reactive, volatile. So, but acquisitions, I think people can spend a bit more time on DD.
Yeah, and maybe before I ask you what portfolio looks like now, have you kind of got a pretty sound do not touch list now? Like, have you honed in the gut instinct on like places to avoid or areas to avoid or people to avoid?
Yeah.
We do have one.
There's a blacklist. It's trial and error. I think on a commodity basis, there's not many. It's mostly correlates to which commodities might not be scarce, might be readily available and abundant on the earth. And then Chris can probably talk more to the jurisdictional stuff.
Yeah, I mean, the jurisdictions has been one that we've got a few battle scars on. We don't say we definitely won't invest in certain jurisdictions, but we certainly like to avoid certain jurisdictions. Some in West Africa we've learnt the hard way on, and I think quite often, again, being value investors, there can be, you can be lured into a value trap sometimes, and a lot of it's, I think, investing in mining stocks and mining in general and exploring and developing mines is difficult enough as it is. To then have to deal with unstable jurisdictions can just add a whole another element that sometimes the value proposition doesn't stack up. Sometimes it does, and we have invested in West African gold explorers and done okay out of them, even in very tricky jurisdictions. But I think it has to have that value backstop there.
Things like Mali, Tabani, those sort of things, they're great assets. Whether you can be there or WAF, whether your stomach is hard enough to take on the risk, that's really the question you've got to ask yourself. A lot of people do, and they make really good money. Choose to be quite selective out of it, maybe sleep a bit better. But we could be making some really good margins out of there. But you can see what happens when it goes wrong as well.
How much is going out to site a part of the process for you guys?
Yeah, it's big. It's big. We try to go on as many site trips as possible. Really, we've been around, done a few. We've been to Telfer, we've been to China, Pete's been to Brazil. We've been all around WA.
Yeah, lots of WA stuff, nice and easy. But over to the US, try to get a feel for things. I'd say probably the Brazil and China trips were probably the most eye-opening. Just seeing what you can do with a cheap and very good labour force over in China. They are light years ahead of us.
Yeah.
But Brazil and Chris can probably talk more through China, but Brazil. I went over there and had a look at the clay projects and Sigma Lithium and a few other things. And I was pretty impressed with what they can achieve over there in very remote areas of Brazil as well. The quality of the geology and the ore bodies out there. There's a lot going for it, Brazil.
Lots of stuff in Australia. Do you know what else is a super important way of meeting management in Australia, mate?
I thought you were about to tell me that the boys have been on a site visit to Sydney.
They have. They're going on another one as well. It's coming up. This site visit they're going on is October 21st to October 23rd in Sydney. Investors go free. It's the IMARC conference, mate.
IMARC conference, investors go free. Guess what, mate? We're going as well.
We're going as well, yeah. It's stacked with a heap of sick speakers as well, mate. 3-day conference, whether you want to chat with small caps, mid caps and bigger companies.
There's government there. There's a whole host of financier type of people.
International companies as well. It's a
big
real
mining
sort of,
service providers, tech.
Yeah, it's a plethora of different names and a wicked way to meet people and just get your pulse on what's happening in the Australian resources market, in the global resources market, whether it be the financing, the commodities or the government angle, like you say, mate. So it's a conference not to miss in Sydney, October 21 to 23rd. Get your tickets.
Come join us.
Should we talk about how the portfolio is positioned right now? I think this is a super interesting part that a lot of people out there would be keen to hear. And you guys have some pretty interesting positions more broadly in the portfolio. So I'd love to hear you guys unpack that.
Sure.
Yes, we're pretty well positioned in cash at the moment, as well as precious metal stocks. But
what percentage?
Precious metals?
Precious would be
Cash and
bullion equivalent?
Yeah. It'd be 50-60.
50-60%.
Yeah.
That's a huge number.
Mm.
It's a huge number.
Yeah, it is. It is.
So-
And
so-
we've never been this high before.
It's a pretty pessimistic kind of view of capital markets.
I think, no, I'd struggle to call it pessimistic as
Cautious.
opportunistic.
Opportunistic. Right, so you're maximising your optionality for it.
Yeah, I think a lot of our strategy has been playing out over the last 6 months. You know, when we were talking about investing in things for 3-4 years ago, they're now being able to be monetized and realized, and it's taken a while for us to get here. But I think it's probably more a factor of giving ourselves a pat on the back and saying well done and monetizing things as opposed to not being willing to invest in things, albeit we wouldn't have the most optimistic view on the global market at the moment.
Is it fair to say that you think opportunities that are showing real value are hard to come by?
I think it's more a factor of harvesting positions that have played out, and then looking to the next investment, really, and just being very aware that markets are at all-time highs. The trade wars are completely in the rear vision mirror. You know, the market's not pricing in any factor of that flaring up again or, you know, blowing up again. You know, those days in April are complete distant memory now. So, you know, the fact that the global economy's, you know, bumbling along, it's growing just. We are in a bit of a Goldilocks scenario where the, you know, inflation's not high enough, but the jobless rates are going up just enough so that they'll ease rates this month. I think we're, you know, but as I said, the markets are at an all-time high. It won't take much for it to pull back a bit, and then we are positioned well to deploy some of that capital. And, you know, things like copper names, we're underweight now, just a factor of selling into some takeovers and things like that. So
to put your it's been harder to find quality assets at decent valuations,
yeah.
but that's kind of a byproduct of the market cycle. In what we believe, we're starting to see higher valuations on things, lower earnings, and that's kind of the time we like to be monetizing things. You have gold at where it is for a reason. You've still got a lot of central bank buying. What is it? The US, Germany, Italy, France have a sort of 70% of their value in reserve in gold. You've got most developed markets at about 20%. And then you've got emerging markets, which for some reason still includes China, at 7.5%. And there's a few of those countries which are remandating that their gold in reserve needs to come up to circa 20%. So you're going to have huge amounts of buying from policymakers, government bodies to try and meet those revised numbers. And I think the stat was if China was to keep buying at the rate it is to meet a 20% gold in reserve percent, it would be buying for around 18 months. Yeah.
18 more months.
18 more months.
Yeah.
So why not put a greater proportion of the fund in gold miners, which can benefit from that margin even in a bear case outlook?
That's kind of what we're doing at the moment. So yeah, there's cash and gold we're still very constructive on, and then strategic assets, again that term, that we think will be important to delivering into Western objectives to disconnect themselves from Chinese supply.
How do you think about the sort of frothiness in critical minerals, strategic minerals, however you want to sort of frame it? There's been pockets in those various markets, whether it be rare earths or others, that have been quite sort of excessive in the runs up lately. Does that give you a bit of pause?
Yeah, I think a lot of it's in those strategic, in those critical minerals and rare earths. It's finding assets that can get through to production, that are not just rock chips and a bit of early stage exploration. It's finding something that may be of strategic value. That's where we really focus on those types of critical and
it's really
strategic minerals.
difficult to bring rare earth assets to market or to production, I should say, and then trying to convince the market to bring on rare earth assets which have never been developed. So you have certain clay projects. You have some which are hosted in chevconite or xenotime instead of the usual monazite, basanite. So there's still a lot of teething and learning to be done for the rare earth industry, and so you can still find very good value in really good assets which have been developed before. So that's kind of where we focus at the moment.
And the gold positions that you still see have some value. Are they producers, developers, both of the above?
We've actually we've entered a few explorers of late. Yeah,
We've been
explorer
coming down
developers.
down the chain a bit.
Yeah,
the curve.
expecting
Yeah.
the retail further to go further down, you get the more outsized returns.
Yeah, I mean, you could find the returns a year ago in some pretty big names, and they've been doing a lot of catch up over that time, and now they've sort of caught up. And I know I'm kind of going against what I'm saying about gold going up even further, but the flow of money has been so prevalent now. It's pushing further down into well, it's already been through developers, and now it's starting to push through into explorers. Still a lot of money to be made in all three areas.
It's just where we see the value.
That's where we see the value.
Where we've, previously been in the Rameliuses and the Spartans, and it's rolled over into some other ones, and then now it's rolled down the curve into explorers. And there's been a couple of really compelling explorers / developers that we've seen lately, which we've invested in.
Yeah, because everyone's been focused on the producers, so there hasn't been a lot of capital flowing into these explorers.
When you say explorers, do they have a resource or?
Generally they'll have hints in and around the area, or they'll be bringing it to market, for an IPO, but it's more of a defined resource which could expand. I think development we more or less classify as where the discovery exploration is over. Yeah,
it makes sense. And there was a quote from Dahlia you shared with us last week. He says, "It's an unhealthy market bloated with fat / debt. A doctor would warn of a heart attack." Do you think a heart attack's on its way?
Certainly hope not.
Possibly.
We're positioned well if it does.
Yeah, exactly. Yeah. I don't know if a whole lot of cash and gold helps with heart attacks, but if it does, then we'll be sitting pretty.
It does help you sleep easier without the risk of high cholesterol and heart failure.
I think he's right though. I mean, it's a very toppy, very bloated, debt bloated globe at the moment, especially for Western countries. So something's got to give.
How do you think about sort of constantly reassessing that worldview and where the portfolio sort of sits? Is that weekly meetings between you guys, or just looking at benchmarks out there, indices around the world, commodity prices, these sorts of things?
I mean, we're doing it. We're looking at it day and night, and so we're obviously just discussing it every day. But we have weekly meetings where we go through the portfolio, go through the news of note, different macro, micro changes, specific things that happen in certain commodities. So we're constantly, learning and evolving our strategy. And one thing we make a note of doing is after we exit a position, whether it's for a good reason or a bad reason, we discuss what went right, what went wrong, what can we learn from it, and we take that forward with us into our new investments.
It's striking that you've had such enormous returns from exploration success or kind of like bull market kind of dynamics, and now the portfolio is so defensive. Like to make that switch, it's rare. Normally, people kind of they'll double down on the thing that has already worked as opposed to taking a vastly different strategy. And if you get this right, it's just a remarkable capital allocation.
And if we get this wrong, I'm sure we'll cop a bit of hate. But as we sort of said, it's not because we're ultra bearish.
Yeah.
I do think the global economy can come out of the other end of all these, tariff wars and bloated debt and deglobalization issues by productivity means. So electrification, AI, robotics, things that are going to stimulate the globe, things that are going to bring real demand to commodities can definitely pull us out of all this.
And don't get us wrong, we're extremely constructive on commodities and the commodity outlook for the medium and long term. It's just at this very moment.
Do you want to be piling in at the top of the market, or would you ideally try to do it lower? And maybe we're being too cute, but I think you've got a bit of time to have all this play out.
And if the opportunity arises, we invest in it. It just so happens that right now it's not in front of us. We've got our strategic investments.
Like we did just take an investment in a rare earth hopeful where it's got a joint venture with another major mineral sand rare earth producer in Australia, and there's an asset over in Kenya that they're looking at, and the strategic importance of those to both the governments. So where it makes sense, where it meets our quality threshold, and where it falls into one of our strategies, we'll definitely still look at it.
I still feel this sort of real philosophy on managing money that it is your money in the fund. You're not trying to, in a sense, knock it out the park in terms of performance at risk of having a base of wealth that kind of grows. Is that, am I picking up on it right?
Yeah, I think, where you haven't been in the industry for 10, 20 years and you're trying to set yourself up as the new fund manager, you want to be getting some decent returns but not risking everyone's capital just to get it, because it's not like you can close up the fund and move to the next one. So we are cautious with the way we use our money. But to date, the strategies that we've implemented have proven to be quite lucrative, so we'll continue running that out.
Speak to me a bit about some of those themes that you're very kind of constructive on with a more medium-term outlook, and is it going to be more of the same in terms of the types of allocations that you've had to date, or do you think you'll lean kind of harder into different types of commodities?
I think rare earths is still front and centre and quite prevalent. I mean, we've got one or two mines in the Western world now, and we all know how important rare earths are going to be for electric vehicles, robotics, weaponry. It's going to play more into that defence discussion that we had earlier. I just think that there's some real strategic assets out there that can still generate a lot of value, like that Commerce Resources that we mentioned earlier, which has largest
project.
Ashram project. It's 200 million tonnes at 2% TREO with good met characteristics. There's things like that which strategic assets in strategic minerals, which we still think there's value to be made.
And people forget as well, there's only two producers of rare earths in the Western world. Two well-known producers. The rest of it is controlled by China and China allies.
And stuff like that,
there's a lot of work to be done there, a lot of money to be spent to get Western countries up to where they need to be competitive. Yeah,
I think that plays into that NATO spend as well. There's a lot of one of the amazing things about that is not just the 5% of GDP; it's the 1.5% of that can be spent on infrastructure. So it's assisting some of these projects which might not have great access to ports and things like that, getting those to market. I think that's going to be huge in the commodity space in the next 10 years.
And you mentioned the sort of constructive look on commodities in general. Obviously, rare earths you've just mentioned as well. Are there other specific commodities or pockets or themes that you're super bullish on as well?
I still think lithium, despite where it's sitting right now. I think if you can find a potential tier one asset, and it's quite good to be an explorer at the moment in lithium instead of a producer or a developer because of the hard times that the prevailing prices, deploying onto those companies. I do think lithium. I think we're very early in the demand thematic there of the EVs, of the robotics, of the BESS.
Yeah, people forget that it is a nascent industry. It's early in its days of development. It's only been through 2 or 3 proper cycles as part of the electric battery revolution. So it's going to take some more time, some more cycles to level out. And that makes it even harder when your demand profile is changing so dramatically year on year. But if you can invest in hugely quality early stage assets, then I think that's the best way to squeeze the lemon when it does grow.
You also mentioned coal, which I'm quite curious about. Sort of a much more established market than lithium, but also the commonality of trading into the cost curve and these sorts of things. Have the lessons you've learned in the past couple of years guided you to a couple names, or just watching it from the sidelines for now?
Yeah,
We've definitely learned some lessons, good and bad.
flight to quality is what we've done.
Flight to quality.
Really.
Yeah.
It's, and going up the curve to a Glencore.
Try and diversify it if you can. It's certainly, as we've seen in previous up cycles, it's got a lot of value there to be had. I think we underestimated a little bit how long the down cycle would be.
Yeah.
And I think it's obviously a bit like lithium, a function of how much money flowed into the market when it was booming, and standard cyclical nature of commodities, too much money, too much supply, not enough demand. But hopefully, fingers crossed, we're at the bottom of this next cycle. Hopefully it doesn't take too much longer to play out.
I can't let you guys leave without an overrated, underrated segment, gents. So I'll give you I'll frame a theme, and
This would be funny if we say the same thing or not.
you're allowed to be different. So first one for me is private capital replacing public equity in junior mining. Overrated or underrated?
Private capital replacing private equity.
Public equity.
Public equity.
Yeah. So like, juniors, explorcos, staying private longer.
I'd say it's underrated.
Yeah, I think underrated as well.
Yeah.
I think your cost of capital goes up a little bit when you go public, and your flexibility, the way you're able to execute on objectives.
Yeah, when you're private, you rarely raise the next lot of capital at a lower share price.
No, that's right. Yeah, exactly. So controlling that cost of capital is important.
The public disclosure is just, it's extremely onerous. You don't need to do it. Absolutely don't do it.
I guess if you have the luxury of not having to go to public markets, that's ideal.
Reliable form of capital to progress a project.
Yeah.
It's everything, right?
But as a function of a fund manager, you have to try and, for our mandate, meet certain liquidity objectives. So is it something that we would look at, going all private? Probably not. But therein lies the opportunity for someone that doesn't need our sort of money.
How about activism in the resources space, investor activism?
Underrated.
Yeah, I think it's underrated. I think I implore it. There should be a spotlight on the people driving the ships and making the decisions and earning good money if they do a good job.
I guess,
equally.
this probably feeds into the last question about transparency in use of capital, I guess, in private versus public vehicles. But in public, it's all on show, and your governance should reflect that. Absolutely.
We'll keep an eager eye out for Norfolk in that space.
Wouldn't call us activists just yet. Yeah, probably not big enough to be the activists.
What about the project generator model?
Underrated.
I'll say underrated. Yeah.
Much more prevalent in Canada than Australia. Though we do have our examples here, and maybe rising in popularity. Would you ever back one, or do you think it's just the time horizon uncertainty to discoveries? Maybe not.
I think it depends on the team.
Yeah, I think I would back one, and we kind of have just backed one without. That's not the main reason we backed it, but yeah, I think when there's some really good operators in a specific part of the world, this one's in North America, not Canada, you can generate significant value especially if you've got an existing project, and then it's just a nice to have, like it's a second prong. I think you can generate value for sure.
Yeah.
Government price floors / stockpiles, or any form of governments getting busy in the resources space.
Underrated.
Yeah, underrated. Absolutely. I think it's. I think we're going to see a lot more of it. Hopefully, we see some in the tungsten space soon.
It's a really only logical solution to bifurcate
You've got
from
some at
Chinese
Almonty
supply.
helping you out already, so.
Yeah, I know, but we don't have a government buying it yet. So I think that should be that would be an absolute no-brainer for the US government to stockpile some tungsten, or do a floor price contract with Almonty would be. I think quite appropriate.
It'd be very appreciated.
We'll have a few calls, see what we can do.
Are we going to get one in vanadium?
Underrated, overrated.
This is just I'm just riffing off the price fall thing.
Price
I'm trying to predict the next price fall.
Yeah.
I mean, that would be nice as well. Rare earths kind of makes sense, I guess. Follow suit. There's obviously been a bit of chatter around the Australian government going down that path or not, yet to be seen. But I think it makes sense for those super important commodities that we've already discussed. How do you shore up Western supply while allowing markets and enterprise to have surety on building those projects? And that is, I think, going to be a conversation that investors and governments will need to have for quite a while from here.
I think the problem has been that the China has gotten so far ahead of the Western world in developing these rare earth and other critical mineral projects that the Western nations simply have to step in now and do what they've been doing for the last 10, 15 years, because we won't catch up organically. There needs to be some intervention. So I think that's why it's so underrated and needs to happen.
Feels like a completely different playing field, right?
Yeah,
absolutely.
It is.
Yeah.
It's been a different playing field for quite a while.
Yeah.
That's probably one of your biggest takeaways
That's
from
it.
when you went over there, was just how far ahead they are on planning, execution, controlling narrative, controlling pricing environments. They are very well thought through.
Yeah, they don't get enough credit. They've done just a tremendous job of building their economy and building their supply chains and fully integrating and really shutting themselves off from needing almost anything from the rest of the world.
And things like Made in Australia and those sort of policies, great on paper. I think this is kind of the opportunity for governments like Australia to step up and say, we'll put our money where our mouth is and start following through with some of these policies as it applies to resources.
You sort of think of that as like a 10-year, 20-year type theme?
Probably. I mean, some of the targets for, the increase in 5% of GDP on defence spending, that sort of starts to come to fruition in about 10 years' time. So there'll be a lot of planning, a lot of initial investment, I guess, in trying to get projects up to meet that defence spend cap. But yeah, it's not a short-term thing. You can't just roll out those sort of things overnight, but it doesn't mean you can't start doing it.
Overrated, underrated. Broker research.
Underrated. Love the brokers.
Underrated if you know what to look for and put a dose of realism on some of it.
Yeah, I think they're a good guide that you can, that Chris can use to normalise forecasts and information numbers.
A lot of them do a huge amount of incredible work, and they do site visits that you can't go on and things like that. So it's highly valuable to what we do. Absolutely.
Would you want to rely on them solely? Probably not.
Overrated, underrated, passive flows, ETF flows for moving mining stocks specifically through the evolutions.
I think pretty overrated, to be honest. I think it will probably become more and more important going forward as the money pools continue to flow. But I guess I'm thinking more specifically around index changes and things like that. And quite often the moves are not as profound as you expect them to be.
I think there's a lot of front running involved with them. And then on the flip side, there's also conversely where indexes change and they come out, the flows come out, and the ones that front run it out. So
Totally.
It's a bit of give and take, and I think it's a bit overrated as well.
Yeah. Last one from me. Just the valuations of uranium developers and producers. Overrated, underrated?
As in overrated, expensive?
Yeah.
Probably overrated here.
Yeah, overrated. Yeah. A difficult, very difficult part of the market to find value in our mind.
I think there's a lot of a lack of transparency. It's very opaque, the pricing and contracting environment for a lot of these producing uranium miners. So it's hard for us to get a feel on value and like real value. Developers, yes, it's a bit easier. But there's a lot of corporate stuff that goes in behind these producing uranium assets, which we don't see it. And sometimes it comes to light. You might have seen that recently with a few different names having to disclose their contract books. So it's difficult to find a clear value in the producers.
Gents, we made we wrapped up the potty and then we just started remembering. We got a beer. I feel like it was December last year, but it could have been
November, December.
Could have been
something
November.
like that,
But we tried to
This
predict.
is so good.
We all predicted what's going to be the best performing stock in 12 months' time, the worst performing stock
Yep.
in 12 months' time,
and then min-res price.
and then we tried to predict
You might
MinRes's
have
share
to
price in
refresh
12
my
months'
memory
time.
on all this.
Okay, Pete, you picked to be up the most CCE, the commerce.
Commerce and Ashram, yep.
What
yep.
would that be?
trading
I guess
in
that
Canada?
validates our long only theory.
Yeah.
Yeah, trading in Canada. That's a good question. I'm not sure what it was trading at the time.
Yeah, so we made these bets on the 14th of November last year.
14th of November.
This was a bet over a beer, and your short was Pantoro.
That's done exceedingly.
All right. So
Bad.
I think I've probably lost this bit.
Your min-res pick, $65. Now we've still got
Yeah.
two
time.
months.
This
Still got
time.
2 months.
Yeah.
Months. All right.
Yeah.
I better get buying.
Chris, MTM, great pick. That was a few months before it started running.
Yeah.
Stellar pick.
Yeah. So this is the this is down that critical minerals path.
It's in the name.
Yeah. Well, metallium now.
Yeah. Was in the name.
Yeah. So
Flash
it's
Jewel.
the Flash Jewel Technology Professor Tour out of Rice University. It's extraction of rare earths using non-traditional means is one of the key pillars of their business. The other one's recycling and some other things. But they've since moved. They've onshored into the US. They've got one site. They're looking at others. An interesting story.
Yeah.
And-
What was his short?
And quite interesting, your short is IPX. Now,
Yeah.
I think
Pairs
of those
trade.
two as a
It was a bit of a
sort
pairs.
Yeah.
Yeah. Tried to pairs trade that one.
There's
Didn't
real
really
alpha
work.
there. Well done.
And your min-res price, $45. So
What's
that's
it
close.
now? 35 or so?
Yeah. 37. Yes.
Yeah.
Fluctuates a bit.
Trav,
Yeah.
YRL as your highest pick, Yandel.
Oh, that didn't pan out well. I think some drilling results came out maybe a week
Okay, I
after
might
that,
not
and
be
I sold
coming
my
last.
stock.
Your short was good. I think we can call it 100% on this.
Oh,
Oh,
Je vois.
that's
Yeah,
right.
it took
Ah.
12 days of 2025 before that. Yeah, went to zero. So
yeah.
Wow.
that
Come
was
good.
Very well done.
Yeah.
You knew something we didn't.
No, I did. I knew its debt was unrepayable.
There you go. One of our key learnings.
Your Minres prediction was $15, so it touched that on the way down.
I think I was I went fast.
Yeah,
And
eager.
I might be very wrong by the end of the year, but anyway, we'll see.
I picked Tabani to be the winner.
Yeah.
Yeah.
Good asset.
I can't because
Going well.
that's had a volatile run. I can't remember.
30 odd cents, 32, 33, I think.
Yeah, and it traded up. So this would have been in and around the time Resolute had all their drums. I think a little bit
Wow.
after. So
Oh, so you'd be killing it. Maybe up 3 times then.
I have to double check. And on the short side, Boss.
Wow. Well done.
That's a good one.
Yeah, and
Very nice.
Min's $40.
Oh,
Yes.
well done, JD.
I think you're tick.
The
So,
man.
Yeah.
This has been a volatile
Maybe
year.
we should
so
swap roles.
Yeah, that's it.
2 months to go. Anything's still? It's all still to play for. I'd say.
Oh, we're
Yeah.
choosing our next one.
I think Pete's
Right.
CCE's still got a lot to run. That's
Yeah, so
that's
I'll do
been
that.
handicapped.
Yeah, that's got strong tailwinds. I think for the last.
I'll
2
do that.
months.
And that when I say CCE, it's the reverse takeover by Mont Royal of Commerce. So that'll come to the ASX relatively soon in the next month or so.
Guys, this has been awesome. Appreciate you making your podcast debut with us and sharing your philosophy, how you think about the world, how you've sort of set up the fund and everything that kind of comes with it. So, yeah, can't thank you enough.
No worries.
Thanks a
Pleasure
lot,
to be
guys.
here. Thanks for having us.
Awesome, mate. Massive thank you to the Norfolk guys for coming and joining us. And also a huge thank you to our fantastic partners at Sandvik Ground Support, iMark, get your tickets for the conference. And last but not least, Focus. Check out the platform brought to you by Market Tech. Hoodaroo.
Now remember, I'm an idiot, JD's an idiot. If you thought any of this was anything other than entertainment, you're an idiot and you need to read out a disclaimer.